Coming out of the heels of a week that saw plenty of volatility, certainly centered around that data on Wednesday in the jobs market and on Friday in terms of inflation, but alongside that, significant tech jitters. This coming week still sees plenty to sink our teeth into. Significantly, it's going to be around inflation with the likes of the core PCE price index out of the US and the UK CPI numbers. We've also got the RBNZ rate decision and a raft of other data points out of the UK in particular. So let's get into the week ahead for the week starting Monday, the 16th of February. So first and foremost, let's look at the big ticket items for the week ahead. Tuesday, things really kick off with the RBA minutes coming out, the unemployment rate, which essentially highlights the fact that we've got the jobs report coming out for the UK as a whole in a week that's really going to be very busy for the UK. And things really kick off on Tuesday. Then ZEW economic sentiment out of Germany, Canadian inflation, Wednesday, UK inflation, core durable goods, and the FOMC minutes out of the US. Thursday, inflation out of Japan. So once again, more inflation. And Friday, UK retail sales, PMI numbers for the UK, and then the core PCE price index inflation gauge out of the US alongside GDP, personal income, and personal spending. So let's kick off with the US. That's generally the main market mover when it comes to data. And like we said, really things are going to be focused on Wednesday and Friday. Wednesday, we've got the core durable goods numbers coming out. And then and in the evening, we've got the FOMC minutes leading us into Friday's GDP and inflation numbers alongside PMI numbers. So really it's going to be a pretty busy week. And certainly the feeling from the recent data has been relatively mixed. Now, bear in mind, I'm recording this ahead of the US CPI data release. So we're yet to see exactly how that comes out. But certainly from the perspective of the jobs report, it was certainly a mixed one. We saw a significant beat on the payrolls number. We saw a decline in terms of unemployment when many had been calling for a rise. But then you look into some of the sort of underlying metrics. You look at the major write-down in terms of the 2025 figures. You look at the fact that a significant part of that outperformance on the 130K figure for the month came down to a sort of recalibration of how the numbers are measured. We also see the fact that really when it comes to job creation, it's continuing to just be the likes of the healthcare segment and to an extent education, which drives job growth. And therefore, the rest of the economy still has some significant question marks. Now, bear in mind, over the course of the past week or two, there's just been one jitter after another around exactly what AI is going to do in terms of businesses. And I think it's worthwhile noting that it's not just businesses, in terms of jobs. Businesses. Essentially, when we're looking at the impact and the implications in terms of AI going forward, from an employment perspective, you've got to think that we're going to see higher unemployment. From an inflation perspective, you've got to think that we'd see significant disinflation. So that outlook going forward does provide the need for governments to do more, quite frankly. They're going to have to address this surge in unemployment that's likely to come. And it's going to come against a backdrop of, by and large, huge profits for some companies, other companies pretty much going bust or just like seeing huge value destruction, essentially. So I think there's a lot of volatility ahead for the jobs market for your everyday person in terms of like prices might be cheaper, but then we might see an economy that really needs propping up. You might need the government to be able to be a lot more sort of centrally focused in terms of maybe creating jobs or paying for people that don't have jobs. So I think that increases debt. Then when we see lower inflation, that creates the basis for potentially a more proactive Federal Reserve or central bank when it comes to trying to stimulate the economy. So I do think that despite all this talk about Kevin Walsh maybe being, hawkish or this, that, and the other, I think that just the direction of travel with everything that's happening in terms of AI points towards lower prices and therefore the ability to do more, but also lower jobs, so higher unemployment and weaker payrolls. Now, in terms of inflation, we need to see that inflation continues to remain low for the central banks to essentially act where they seem necessary. Of course, if you look at the jobs data over the course of the past week, you might say, well, they don't need to do anything. And certainly that's going to be the view of some members within the Federal Reserve. But I think over time, we're likely to see AI not creating jobs, but instead taking jobs. If you look at some of the commentary coming from some of the top AI names in the world, they all say that, white collar jobs could be, 50% wiped out within the next year and things like that. Look, ultimately, we're going to see massive upheaval. And I think it's going to be the job of the governments and of the central banks to really try and react to that. All of that is to say that when we come into the GDP numbers, we can see strong GDP. That doesn't necessarily mean that the economy is perfect, because you might see businesses doing well, but then they just switch out humans for AI. I think that's likely what we're going to see over the coming years. In terms of inflation, we need to see that remain low for the central banks to be able to act where necessary and not to be fearful of stoking inflation. And AI should help drive down costs, that's for sure. So personal spending, personal income, those are going to be key figures as we look forward and see exactly how your everyday person is set up, quite frankly. How are they doing? Do they have money? Are they spending money? I think it's just going to be like this. There's a lot of talk about this K-shaped economy, and that's between the haves and the have-nots. I think it's also going to be the businesses against the individual. That's going to be another divergence that I think we're going to see. In terms of the title was wrong on this. Essentially, this is US core inflation. This is US PCE inflation. So the core is the blue, the headline is the orange. You can see both of them elevated roughly 2.8% at the moment. You can see in terms of the monthly basis, it's been relatively elevated for a while now. I mean, if you look at the monthly figures, they're generally around between 0.2 and 0.3. And you need to be at 0.2 and below on a regular basis to be able to get down to 2%. Nonetheless, you can see the December, January, and February figures are relatively elevated compared to everything that followed. That does point towards some disinflation for the next few occasions, next few announcements. But yeah, I don't think we're going to get back down to 2%. I think it's likely we're going to be a bit above that, and then it comes down to the central bank whether they're willing to look beyond exactly what's happening now and really rely on the idea that AI is deflationary. Now, in terms of market expectations, by and large, the jobs report essentially killed any idea of the Federal Reserve cutting interest rates under Powell. So then it pushes on to Walsh, if that's who ends up getting the job. And markets price a 60% chance that we do see a cut in that June meeting. Beyond that, there's a chance that we see another one towards the back end of the year. So the possibility of 2 rate cuts for this year is currently what's being priced in. Do we see any shift around this week's data? I think certainly if you're looking at the core PCE price index release, given the fact that people sort of got quite fearful around near-term rate cuts around that jobs report, I think there's more risk to high inflation than the benefit to low inflation. So if we do see an elevated inflation figure, I think that's likely to lift the likes of the US dollar in particular and potentially weaken the price of gold. Let's just jump onto gold, and you can see here that we've been having a bit of a tough time of late. Of course, we saw that sort of sharp collapse, I would say led by silver, but certainly this was around that Walsh announcement. We've been regaining ground. Now, in actual fact, on Thursday, we saw this announcement that was a proposition from the Russians saying to the US that basically they want to suddenly start working together on a bunch of economic goals. Now, to be fair, Donald Trump has been talking for a while about how they've got these plans to do great things together and everything. So, it's been a hell of a time under Trump, quite frankly. All of his allies are getting sidelined, and he's suddenly buddying up with President Putin. And part of that was discussion around the idea of the Russians getting back onto the US dollar and utilizing that to a greater degree. Now, one of the stories around why people are bullish for gold is around the de-dollarization story. I wouldn't necessarily say that that's too much of a prominent story, but another part of it is around geopolitical uncertainty. So if we would see a deal between Russia and Ukraine, Russia and the US, it makes it a lot more likely that we're essentially going to see a ceasefire between Ukraine and Russia alongside that. And when we're talking about central banks around the world stockpiling gold, a lot of that is also aligned with the idea, and a lot of the purchases from around the world is aligned with the idea that Russia got into a war and ultimately got many of their assets frozen, primarily in Europe. But the idea that they're potentially going to get some of those frozen assets back in this deal, again, sort of weakens the narrative. So ultimately, if we see high inflation data, then yes, this could provide another sort of move towards a downside. I would say at the moment, we're looking like we're it's probably not a trend line thing, but there's a possibility that we're coming into for another sort of wider retracement here. So there is a possibility to move into this sort of 47.60, 48.30 kind of zone. Really we need to break the 46.55 to see a wider next leg lower here for gold. But certainly, if we see higher inflation, if we see less chance of rate cuts, if we see deals between the US and Russia, if we see an agreement between Ukraine and Russia, all those things are negative for the price of gold. On the flip side, if we see weak data coming out in terms of inflation or GDP, things that really point us in the direction of the need to do more from the central banks, which I think will come down the line. So I don't necessarily think that the long-term story of gold is done. I think that the long-term story is still very strong. But, in this point of time, things are starting to shift in terms of the narrative a bit, a little bit more hawkish outlook, the idea of being able to shrink the balance sheet rather than expand it, the idea of the Russia-Ukraine issue potentially getting solved and Russia suddenly starting to utilize the US dollar, so the de-dollarization story goes away. Doesn't go away, but the narrative is starting to change, and you can see why we're seeing some weakness coming into play at the moment. So certainly with the hourly time frame, you can see we've sort of sold off, rallied a bit, starting to roll over a little bit again. So there's some risks here, but certainly I still believe in it for the long term. But certainly some of the things that have underpinned it have started to weaken somewhat of late. Let's jump into the UK. Now, this is really the biggest one of the week sort of narratives, because we've got a huge amount of data coming out of the UK. The jobs data on Monday, the jobs data on Tuesday, the inflation data on Wednesday, the retail sales on Friday. Of course, the most important really is likely to be the inflation rate. And I'm expecting to see, as I've mentioned on this a number of times, well, too many times to recall really, that I expect to see major disinflation within a short period of time, and we're entering that period. And what was notable is that the Bank of England in their last meeting also alluded to that. They expect inflation to get down to target by April. This is a January reading, so you're talking about within the next 4 readings, we're going to get from 3.4 to 2%. And it's starting this time around, right? Look at the expectation, 3%. So already a sharp move lower in terms of inflation expected this time around. Now, alongside that, there's the question mark of, do the Bank of England need to do more? And then the jobs market is going to be key for that. So you can see unemployment expected to remain at 5.1. The employment change expected to collapse into minus 40K. The claimant count expected to rise. So there are some signs of concern or reasons for concern within that. So certainly worth keeping an eye out for the jobs data in particular. But between the weakness in terms of the inflation rate and the possibility of further weakness, certainly within the claimant count, the employment change, but certainly if we saw a rise in terms of unemployment, that feeds into the same narrative. I think a lot of it really feeds into the idea that the Bank of England are going to have to be quite proactive as we move forward. The inflation rate, you can see here, the 8-month annualized figure now at 2.1 and 2.12. So essentially, supposedly within the next 4 readings, which I was saying by April, we should get back down to 2.1 is what the annualized figures are telling us. That if we do see the minus 0.1 expected here for the monthly metric, that's going to bring down the annualized figure as well. So then the 9-month annualized is likely to be lower than 2.1. So again, pointing really to a return to 2%. But at the moment, we're above the 3s. And so it's going to be a really interesting one. I'm going to enjoy watching this drop, because in the UK, we want to see interest rates fall, in particular people that have got mortgages that are rolling over. But it's been elevated for some time now. So most people, myself included, have had to deal with higher mortgage costs. But soon enough, we'll be able to see additional easing. The degree to which that easing comes into play remains to be seen. And certainly markets currently pricing a 60% chance of a cut in March. And then beyond that, not much more really. A return to potentially 3.25 later on in the year, coming into the beginning of next year. But I would say there's room for more. There's room for the Bank of England to ease to a greater degree than to just flatline at 3.25. And so certainly the disinflation story should really play into that and potentially point towards further weakness for the pound. Now, if we're looking at charts, one of the charts that I've sort of been looking at throughout this whole thing has been euro sterling. In actual fact, it sort of rolled over the course of the back end of last year coming into this year. But since that Bank of England meeting, we have seen some strength coming into play. So there's a possibility that we do see the bulls starting to return once again here. Certainly a breakthrough 874 would give me greater confidence that that's the case. Of course, there's a risk here of a head and shoulders formation. But we've held up around that neckline at the moment. We're rallying up to that resistance level. If we break through that level, it gives you greater confidence that the bulls are going to remain in charge. But that's certainly the sort of line in the sand that I really would want to see broken, to see the bulls back in a more confident setting. And certainly if we do see the idea of disinflation really pushing and permeating through markets, the idea of additional rate cuts coming into play, I think weakness for the pound does seem pretty likely. And then finally, let's look at what's happening in New Zealand. Now, the key thing here is that we've got a rate decision. The markets are expecting them to keep rates at 2.25. And certainly if we're talking about rates at 2.25, and a minute ago we were talking about the UK being at 3.25, you can see they've already cut rates to a pretty significant degree, right? So this points towards maybe not easing, but maybe tightening down the line. That narrative certainly has been building for for Australia, and the New Zealand dollar's kind of gone for the ride as well. But certainly we're starting to see a narrative around the possibility of a rate hike in the not too distant future. You can see that at the moment, 3.11 on the inflation does point towards a need to be tighter, quite frankly. And you can see in terms of the quarterly figures, 1% and then 0.6%, you know, they're pretty chunky prints, in particular that 1% figure. And so the 2-quarter annualized figure puts them roughly around 3.2%. So essentially just a little bit above where the year on year is at the moment anyway. So inflation is a bit of a concern, and inflation expectations are on the rise rather than falling. So there is a perception that they might need to hike in the not too distant future. You can see that here. So at the moment, there's absolutely no chance of a rate cut according to market pricing, and instead pricing in a possible rate hike to come in September of this year. Of course, this means that markets will be quite sensitive to data as we go forward to sort of enhance the chance or write it off. But this week really, I think, will be interesting as we see the commentary coming out alongside this decision that by and large markets don't think they're going to move, but they do think there's a chance we move later on in the year. The price of the New Zealand dollar has been on a rip. Now it's come up towards this zone of resistance that you can see here. There we go. So we've sort of come a little bit lower than that. So this area of resistance against the US dollar, and sort of started to move a little bit lower at the moment. Of course, there's this dollar strength story coming into play at the moment as well. So we'll have to see how that narrative shifts over time. But certainly the New Zealand dollar is one of the stronger currencies out there. I'd expect more of the same as the Australian dollar. And if we do break through the 612 mark, then it points towards a possibility of a resurgence coming into the fold. Bearing in mind that the likes of the New Zealand economy, the Australian economy will benefit from the rise in terms of commodity prices that has been playing out. And I think will likely play out over the coming years as we have this fight for resources, as people try to build up data centers, try to win the battle over AI and electrification, particularly between China and the US. So this battle for resources does benefit these economies. So a stronger currency going forward wouldn't necessarily be off the card. So I wouldn't be surprised to see a turnaround in terms of this long-term trend if we see a breakup through that 612 mark. Again, you know, there's other currencies also to take a look at. Like we said, the pound, New Zealand dollar against the British pound is probably going to be an interesting one as well, because there we go. That has, again, a downtrend in play, but then this resurgence coming into the fold at the moment. So are we going to see a turnaround for the New Zealand dollar as a more hawkish stance takes shape against the backdrop of, particularly in the UK, the possibility of additional rate cuts. And then, these economies looking pretty decent if we see commodity prices on the rise. And with that in mind, worth a glance at the all-important global dairy trade price. So heavily reliant on dairy in particular in New Zealand. And in actual fact, we've seen very strong price growth in terms of the dairy trade figures over the last two outings. So it may be a little bit of a left field one, but that actually has the propensity to move the New Zealand dollar. So keep an eye out for that release as well coming into play on Tuesday. I hope that's been useful. Make sure to like, subscribe, and follow for more. My name's Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day and have a great week ahead.